Hi, my name is Amy Leach, and I'm one of the coaches with the Heartland Foundation. And today I'm going to talk to you a little bit about college funding and things we use to get college funding and where college funding can come from. The first thing we're going to talk about is basic financial aid information and what you need to know. And the first thing is that federal financial aid is based on financial need. So if you have a family income over $75,000, you're going to see a significant reduction in your need-based financial aid. Now, this is just need-based. It's not scholarships, grants, and other institutional loans based on student merit and other things. The other thing you should know is the average Pell Grant is $6,000 a year, and the average subsidized student loan is $5,500 a year. So when you're talking about need-based financial aid, you are not talking about a huge significant amount of money. Now, if you have financial needs, $6,000 is a lot of money. But when it comes to the overall funding of college, it's really a small percentage. Now, the other thing I want to say is that regardless of your family's income, you need to fill out your FAFSA. And the reason for that is that schools award other financial aid not just based on need. They award merit money and those kinds of things. And if you don't have a FAFSA filled out and on file with the college, they aren't going to award you that type of funding. So it is imperative that students, even if they have a large income, fill out a FAFSA. The next thing I'm going to talk about is how family assets are looked at on the FAFSA. And then we're going to talk about things you can do to help kind of reduce that, how that income is looked at. So the FAFSA and financial aid uses a formula that calculates kind of families' income, and then it looks at what is going to be their expected family income, EFC, expected family contribution to college tuition. And this is how they look at it. First, they look at student assets, and they look at those at 20%. Student assets are investments, real estate, things in the student's name. The other thing they look at is student income. Now, yes, it looks at student income at 50%, but if the student's income is under $10,000, they don't look at that. So if you have a student, though, that has a great job and is making $15,000, $20,000 a year, then that income is going to be looked at as that they can contribute 50% of that towards their college tuition. And we're going to talk about that again in just a little bit. But that's one of those things that student income is looked at very different than parents' income. Parents' assets are only looked at between 2.6% and 5.6%, and that's on a sliding scale, and that sliding scale changes every year. But parents' assets are things like investments, stocks, money in the bank, that type of thing. And then parent income, again, another sliding scale for this, but parent income is truly based on your tax return. And when you complete a FAFSA, you're going to transfer information from your tax return directly to the FAFSA. And that truly is where that comes from. But there are things we can do to reduce parent income a little bit that can have an impact on FAFSA. So here are some things that can affect what's on your financial aid form and things that can benefit you to reduce your income so that you're more eligible for financial aid. There are some good types of assets, retirement accounts and IRAs. Those are not counted against you on your FAFSA. So if you're in the income range between say $60,000 and $80,000, $85,000, if you can contribute a little bit more to your retirement account, that will reduce your income, which will increase your ability to get need-based financial aid. The equity in your house or equity in your business and annuities are not counted as assets on your financial aid form. So all those types of things can really be advantageous. Now, there are assets that belong to a student, or a parent will move assets to a student to reduce their tax burden. This generally does not help the student in terms of financial aid because the student assets are looked at such a higher level than the parents. 529 plans and coverall plans are two of the better options for college funding because A, they're not looked at for financial aid, but B, more importantly, when you withdraw from those plans, you don't see them. So families do not get counted against them as income when they withdraw from their 529 plan, whereas some of our other assets, say we withdraw from an IRA or from an annuity to help pay for college, that money would show up as income then. Now, the other thing I want to point out is that every institution is different. Public colleges use one formula, private colleges all use their own formulas. So if your student's applying to a private institution, know that each college will calculate its aid very differently, and they will look at family assets differently. Institutions can look at investments, how much you owe on something, all those things to determine your financial need. Private colleges often have families fill out not only a FAFSA, but what's called a CSS profile. And what this does is it's much more in depth than a FAFSA, and it looks at income a lot differently. It will look at not only income, but also liability. So if you own 2 or 3 properties, but have payments on those properties, the CSS profile would account for that. Whereas on FAFSA, it doesn't always account for that. So know that each institution will look at its own methodology. Additionally, each institution is awarded a different amount of financial aid. So we always want our students to apply early, because that way the chances of them getting that money go up significantly, because once those funds are awarded, the institution doesn't always get more funding. The last thing I want to talk about is students and how the students can help contribute to paying for their college. One of the first things I want to talk about is saving half of their income from summer jobs or jobs they have during the school year. Now, remember back up in the first slide, I talked about student income can count against the student, and it can. But once it's over $10,000, most students working a summer job, working a job during the school year, aren't making over $10,000 a year. So when they file a tax return, they're getting a refund. And that income is not going to count against them on the FAFSA. But if they saved part of that money, they would have those funds available to help them pay for college. Saving money when parents, family, friends give you money from graduation and holidays and birthday parties, that kind of thing. Just sock a little bit of that away, because when it comes time for college, then you've got some cash there. Apply for scholarships. You can start now. You can start as a freshman, sophomore, junior. Now, most scholarships for anybody but seniors are going to be essay-based scholarships or contest-based scholarships, and that's fine. Take a little time, 2-3 times a year, and apply for some scholarships. Every past U.S. president has an annual essay contest. That's one of the scholarships that's available from freshmen to college seniors. If you Google search scholarships for high school freshmen, sophomore, junior, whatever year you are, it will give you a huge list, and it will take you to links to look for those scholarships. The Prep Scholar blog for scholarships for high school sophomores and freshmen is a great link, and that's the link I have on this page. But just Google searching, you will find that scholarship information. Thank you for letting me talk to you a little bit about college funding today. Again, my name is Amy Leach. I'm one of the coaches with the Heartland Foundation, and feel free to get more information by contacting your local college planning consultant, a Heartland College planning coach, or contacting our main office.